Have you ever wondered what your medical practice is worth? The internet is filled with information on EBITDA multiples, rules of thumb, and how medical practices are being acquired by hospitals and private equity firms. This can leave you feeling anxious and unsure about navigating the valuation process. I am bringing this up because I encounter doctors that for one reason or another need to know the value of their practice, yet they don't know what business valuation should look like or what its key components are. My name is Alexey from APPRAISALS. I'm a certified valuation analyst specializing in doctor practice appraisals. In this webinar, I will guide you through the 3 valuation approaches that can be used to value a medical practice: the income approach, market approach, and asset approach. I will explain the specifics of each approach and show you some calculations to give you some practical understanding of the steps involved. Before we get to the 3 valuation approaches, it's important to define the details of the valuation engagement. I want to cover these 4 key points. First, we need to establish the valuation purpose. This is important because valuation purpose can define valuation methods that we are going to use and assumptions that we might make in the valuation process. Valuation purpose also influences the standard of value. You probably have heard of the fair market value standard, but there are 3 other frequently used standards of value: fair value, intrinsic value, and investment value. Identifying a detailed description of what we're valuing is also very important. Are we valuing common stock in the company? Or are we valuing certain assets that will be sold in an asset sale transaction? From my experience, most medical practice transactions happen as asset sales. In all of our valuation examples today, we will assume that we are valuing 100% equity interest in the practice. This simply means that if the practice was a corporation, we'd be valuing 100% interest in the shares of the corporation. Lastly, we need to define the date of the valuation. Appraisals are done as of a specific point in time, just like balance sheets. Now let's move on to the 3 valuation approaches, starting with the market approach. Market approach is probably the most fundamental approach in fair market appraisal. However, applying it in a valuation of a medical practice can be very difficult because of the lack of market data. Most of you have experience looking at real estate transaction data, which is generally available in public records. Unfortunately, information on medical practice transactions is not public and is very limited. On top of that, data can differ significantly depending on the practice size, location, and specialty. For example, a valuation multiple for a primary care practice will be probably very different from the valuation multiple for a plastic surgery practice. Application of the market approach can be broken down into these 4 steps. First, you want to gather your comps and calculate your multiples. Then you want to apply your multiples to your company and then reconcile different indications of value. Common valuation multiples that are applied to medical practices are price to revenue multiple and price to seller's discretionary earnings multiple. Seller's discretionary earnings, or SDE, is a measure of business earnings in an owner-operated business. It includes owner's salary, net income, discretionary expenses, interest, and non-cash expenses such as depreciation and amortization. Here's a sample table with some sales data on medical practices. Using this data, we can calculate price to revenue multiple and price to SDE multiple. In our example, these multiples are 0.4 and 1. Now that we know our market multiples, we can apply these multiples to our practice data, such as revenue and SDE figures. Here's an example of what that calculation might look like. Practice revenue of 1 million multiplied by a price to revenue multiple of 0.4 gives us a value of 400,000. Practice seller's discretionary earnings of 500,000 times a price to SDE multiple of 1 gives us a value of 500,000. As a last step in the market approach, we weigh these 2 value indications based on our confidence level in the market data and how it applies to our practice at hand. In our example, we weighted both of these at 50%, resulting in a total practice value of $450,000. Now let's move on to the asset approach. The asset approach, also commonly known as a cost approach, involves valuing each component of the business separately. Asset approach is most commonly applied to asset-intensive businesses. In the healthcare space, an example of an asset-intensive business would be something like a surgery center or an imaging center. Asset approach generally is not used to value service businesses like medical practices. Medical practices and service businesses drive most of their value from intangible assets like goodwill. For example, a typical primary care practice, even if it's very profitable, probably won't have a lot of tangible assets in place. As a result, it will generally be valued based on its earnings. Under the asset approach, there are many methods that we can employ. For our example today, we're going to use an adjusted book value method. In this method, all assets and all liabilities are adjusted to reflect their fair market value. Fair market value of company's equity will be equal to total fair market value of liabilities subtracted from total fair market value of assets. Let's take a look at an example. For this, we'll need a company's balance sheet. On the left-hand side of the balance sheet, we can see the historic account balances. We can see that 4 adjustments were made to the historical balance sheet. Accounts receivable were added, fixed assets were adjusted to reflect their fair market value, accumulated depreciation was eliminated, and some intangible value was allocated for the trained workforce in place. Now let's take a look at the adjusted column. Total value of assets now is $300,000. Total liabilities are $100,000, leaving us with an equity value of $200,000. $200,000 is the value of the practice under the asset approach. The third and last approach that we could use to value a medical practice is income approach. Under the income approach, we are viewing the practice from the perspective of an investor. As investors, we would want to understand the business's ability to generate cash flow. We would also want to understand the risks associated with this business and how they compare to alternative types of investments. Under the income approach, business value is determined using valuation methods that project future cash flows and convert them to present value. Present value simply means that $100 received today is worth more than $100 received in the future. Although this approach can be challenging to apply at times, if you can make a reasonable forecast of cash flows and you can determine an appropriate rate of return, income approach is really the best way to use an evaluation. There are 2 valuation methods that we can use under the income approach: capitalization of cash flow method and discounted future cash flow method, commonly known as DCF. There's also capitalization of excess earnings method. It's typically used to value unidentifiable intangible assets such as goodwill. However, it's something of a hybrid between asset and income approach. I may cover it in a different video. Under the capitalization of cash flow method, we utilize Gordon growth model. This model assumes that expected cash flow for next year is going to grow at a stable long-term growth rate into perpetuity. Here's the formula. Business value is equal to next year anticipated net cash flow in the numerator divided by the discount rate minus the long-term growth rate. This formula is pretty easy to follow. However, if any changes are expected in the near future, it may be best to use a different valuation method under income approach called discounted future cash flow method. The discounted future cash flow method allows for greater flexibility and precision in projecting changes in future cash flows of the business. A great example of when this valuation method would be useful in a medical practice valuation is when a practice is losing a provider or gaining a provider. Changes in provider coverage will affect practice's revenue and expenses, and if we can project those, we can assess a more precise value of the practice. Here's a formula for applying a DCF method. Under the DCF method, we first project future cash flows for a discrete number of years, and then bring the value of those cash flows using an appropriate discount rate. Next, we determine the terminal value of the business at the end of the discrete period that we projected, and bring that value to present value as well. Terminal value simply means the value of the business at the end of the discrete period. The sum of these 2 present values will give us the value of the business. Let's take a look at an example of an income approach using the capitalization of cash flow method. In our example, the practice generated the following cash flows for its shareholders: $130,000 in year 1, $140,000 in year 2, and $150,000 in year 3. Let's assume that we believe that the most recent level of cash flows, $150,000, is likely to continue growing at a stable long-term growth rate of 3%. We will assume that our discount rate is 25%. Based on these assumptions and excluding any discounts for lack of marketability, the value of 100% equity in this practice is worth $702,000. Now that we have calculated the value of our practice using 3 valuation approaches, we need to weigh them based on our confidence level in each approach. Let's take a look at the reconciliation table. Market approach gave us the value of $450,000, asset approach gave us the value of $200,000, and income approach gave us a value of $702,000. Let's assume that when we were valuing this practice, we couldn't really find any good comps for this particular specialty, and we feel a lot more confident in our income approach. We also can see that asset approach gave us the lowest value. That is likely due to the fact that it doesn't fully account for practice's goodwill. Under these conditions, you may assign 100% weight to the income approach, and market and asset approach will be given a weight of 0% for a final value of the practice of $702,000. And this concludes our webinar. Although this material was heavily condensed, it should provide you with a framework for understanding business valuation process. It should also give you an idea of what you can expect to see in a business valuation report. I hope you found this information helpful. If you have any questions, please feel free to contact me. Thank you for watching, and I'll talk to you soon.